By now, I suspect at this stage in the course, you've got the impression that there are as many definitions of value investing as there are practitioners. Because it makes sense. Only the victors get to write history. And you read a lot of war stories from people who've been successful value investors. And probably the best example I can think of course, is the Warren Buffett annual report, where he writes his letter to the shareholders, or Berkshire Hathaway. And you read through that and you say, damn, this guy is smart. I mean, he bought American Express when it was out of favor, and he bought Coca-Cola when it was out of favor. I mean, this guy really knows his stuff. And all of that's sort of helpful if you're trying to enter the value investing arena, but that's ancient history. That's stuff that's so far under the bridge that it doesn't help you now. What you need to know now is what are today's value investments. You know that Coca-Cola is just a manufacturer of sugared water, and so that's yesterday's story. So tonight I'm going to give you some examples of screens that I use to identify what I'm calling extreme value or deep value investing. And then I'll morph a little bit and suggest how you can look at companies if you want to add a little bit of sex appeal, a little bit of growth potential, a little bit of what Warren Buffett might call franchise value. And how you can be willing to pay a little more, but not too much more. Because if you pay too much more, you're encroaching in that dreaded territory that's occupied by the GARP investor, the growth at a reasonable price. And once you're there, you're, 3/4 of the way to being a sell-side research analyst where you just produce stuff. I mean, everything is cheap from those guys because they're forecasting things based on fiscal 2010 earnings per share. So I'll provide some ideas as to how you can pay a little extra, but how to know how much is too much. I'm going to provide you with some specific examples right here in Canada of companies that meet the extreme value criteria. And then at the end of it, you might think, well, why are you giving away the secret sauce? I mean, the guy from Coca-Cola doesn't show up here and tell you what's in the magic formula. So toward the end, I'll tell you why, even though you know the secret formula, 90% of you or so won't be able to do it. And partly it's because of things that are intrinsic to you. It always sounds good on paper, but when you actually get there, it's like going on a blind date. It sounded like a good idea at the time, but when you get there, you think, geez, why did I agree to do this? So one reason is that it's intrinsic to you. Another are extrinsic factors, things that are to do with the outside world, the organization for which you're employed, or maybe the clients that you have. And so that's probably going to lead us into the discussion at the end, and I think we've got plenty of time for that as well. So let me start off with my version of deep value investing or extreme investing. And it's a variation really on one that I hope you're already familiar with, which is the Ben Graham net working capital approach. And I didn't come up with this. I got this from probably 20 years ago from a research analyst at Oppenheimer in the US. And he called it his buy a company, no money down screen. And so his rationale, his thought process was, well, let's assume you're going to see a friendly banker. And, well, in those days, bankers were friendly rather than nervous. But anyway, he said, let's assume you're going to a friendly banker and say, what will they loan me against various kinds of collateral? And typically, a banker will loan you 100 cents on the dollar against your cash and short-term investments, right? Because a banker will always loan you money if you don't need it. So 100 cents on the dollar for your cash and short-term. For your receivables, so maybe 75 cents on the dollar. For your inventories, maybe 50 cents on the dollar. I mean, we need some sort of rough and ready rule of thumb because we're doing this screening to find candidates. For your fixed assets, that's a bit trickier because it depends really what they are. If you've got land and buildings that you've been sitting on for 100 years, then presumably they're dramatically understated on the balance sheet. But alternatively, if most of your fixed assets, if you're saying retail, most of your fixed assets are coat hangers, and stuff like that, and change rooms, and so they don't have much value to anybody else. So we, as a rule of thumb, say, well, we'll pay for this purpose when we're screening. We say the banker will loan you 100 cents on the dollar for your net depreciated fixed assets. Okay, so we've gone down the left-hand side of the balance sheet, the assets, and we've extended out. We've said 100 cents on the dollar for your cash and short term, 75 cents on the dollar for our accounts receivable, 50 cents on the dollar for our inventory, and 100 cents on the dollar for our net fixed assets. So that's the collateral value of the assets. So now you go to the right-hand side of the balance sheet and you say, okay, well, don't forget, I'm the banker now. And the banker, I'm not worried about accounts payable and all that kind of stuff, because if the company goes belly up, those guys get stiffed, right? You don't pay your suppliers or the landlord or anyone like that. So you only deduct from your collateral value interest-bearing debt, because that's what the banker has loaned you. Interest-bearing debt, term debt, maybe convertible preferreds, convertible debt, maybe not even the preferreds, but certainly convertible debentures. So you deduct all of the interest-bearing debt from your collateral value, and now you've got net collateral value, right? So you divide that by the number of shares outstanding, and now you've got your collateral value per share. So now what we're looking for, we're screening for, are companies where the stock price is below the collateral value per share. So essentially, it's below the liquidating value. And Norm Wanger, who was the guy at Oppenheimer who told me about, well, he wasn't me, I mean, he went around telling everybody, he told us about this screen, said, everybody wants to be an investment banker. He said, with my screen, anybody can be an investment banker. He said, hell, my wife could be an investment banker. Because that was in the days when he could make disparaging remarks about your wife. But he said, my wife could be an investment banker. And this is 30 years ago, don't forget. He said, what you do, you go into the bank and you say, I'd like to borrow $50 million, $75 million, $100 million, from the bank. And the banker, rolls her eyes and thinks, okay, another smart aleck, from Western with an MBA, thinks they know everything. What are you going to give me as collateral? You got a nice suit, whatever, but, I don't know you. And you pull out the annual report of the company and slap it on the banker's desk and say, here, madam, is my collateral. And they loan you the $75 million. And you just take it over and liquidate the business, and you got money left over. Sounds neat, right? I mean, doesn't everybody say, that's why I say, sounds good on paper. And at one time in the early 80s, when you ran a screen like that, you'd get 3-4 pages of printout, computer printout. So that's probably 100, 150 stocks. And you could pick and choose and decide which ones you wanted to focus on. Now, if you run that kind of screen in the US, you maybe get a page, maybe at best, maybe half a page in Canada. And so you say, well, that's an interesting screen. It's extreme value, but it's not much use if nobody pops up on the screen. But surprisingly enough, there is a company that pops up on the screen, and my associate Taras and I visited them on our way here today. It's just down the road in Kitchener-Waterloo. It's listed on the Toronto Stock Exchange, so we're not talking about wacko, emerging biotech companies. And let me show you how we go through the numbers here. The company's called Vertex Vision, okay? And as I say, it's located on Bridge Street in Kitchener-Waterloo. And this is what you do. I did it, and I didn't do a fancy PowerPoint, because if you have a real job doing this sort of stuff, this is what you do. You get the annual report, and you start marking it up. And here, this is October 07, because they have a January fiscal year. So this is the most recent quarter. And they have, you'll see, the sum of these two is the cash value, 7.6 million. So we give that 100 cents on the dollar, right? They've got 11 million or so in, accounts receivable. And so that's worth 75 cents on the dollar, that's 8.5 mil. They've got almost 8 million in inventory, 50 cents on the dollar, that's worth 4 million. So capital assets, those are depreciated already, so that's 3 million. And actually, we visited the company, so they've got a nice-looking building there and all kinds of equipment and cubicles and stuff, so there are real assets there. So we're giving that 100 cents on the dollar. We think we could liquidate for that price. So the sum of these is the collateral value, 23 million, which is a material discount to the carried value according to the accountant, because we aren't giving any value to goodwill, intangibles, intellectual property, all of that kind of stuff. We're saying that's worthless. May not be, but for our purpose. They don't have any debt to speak of, only 1.5 million, and we count that 100 cents on the dollar. So our net collateral value is 23 minus 1.5, 21.5. Shares outstanding, 33 million, and we have a net collateral value, therefore, 65 cents. So the big question is, so where's the stock? And the stock is 40 cents, and it's listed on the Toronto Stock Exchange. Now, how irresistible is that? Now, you don't want to have your entire RSP in this, I don't think. But if you could, as Ben Graham would say with the net working capital approach, if you could create a portfolio with a handful or more than a handful of stocks with this kind of characteristics, wouldn't you say that this is a no-brainer? What's particularly attractive about Vertex is that, I mean, sometimes you do this sort of thing, and it turns out that they're involved in the textile industry in New England. And you say, oh boy, that's kind of on its way out. Or the shoe industry, actually, in Ohio. Actually, I own one there, and should have held it longer. It's called Rocky Mountain Shoe, I guess. And they made hiking boots and industrial boots and things of that kind. And they were in the shoe industry in Ohio. And everywhere else, I think, in the U.S. had closed down, and they were the only survivors. And it was a great stock. So just because it's in a mature industry doesn't necessarily mean it's a bad investment. But certainly, it's tough to imagine finding anything cheaper than this. essentially the market cap of the whole company is 33 million shares times 40 cents. So what's the market cap of the whole company? 33 times 40, 12, $13 million. You could buy the whole thing. George could buy this with his self-directed RSP on his own. I mean, this is so cheap. This stock is so cheap. Half of it is cash. I mean, he'd get half of the money back in cash right away. And they are not in a declining industry. They are involved in laser technology. They make lasers that are used in engraving, marking, templates that are used when you're laying out roof trusses, maybe laser cutting for solar panels, things of that kind. So this is a neat technology company. Half of the market cap is cash. Discount to book value, discount to net working capital. Here, this 47 cents is the traditional Ben Graham approach. Remember, current assets minus all liabilities divided by number of shares is net working capital. That's 47 cents. So here's a stock right in your own backyard that actually is a huge discount by anybody's measure in terms of a value stock. Now, one problem, though, of course, here is that the whole darn thing is only $13 million market cap. So if you're Fidelity or Great West Life or Templeton, you look at something like this and you say, well, fine, but in the first 5 minutes of trading, we own the whole company. And then what do we do? And so there's a general agreement that maybe it's cheap, but truly most or many value stocks are small cap, and that's a characteristic that you'll find, I think, in a lot of the academic studies. The other objection that people make to this approach is to say that this is very balance sheet oriented. You're given no value at all to the goodwill or the intangible assets. And when you visit companies or they visit you, management often says when you're saying, I'm not sure that your stock is underpriced or we're not sure where the value is, they say, yeah, but you're not giving any value to the great intellectual property, all of the R&D we spent over the last few years. We got a lab full of PhDs and what have you. You should give some value to that. And they have a point, I guess. And so you've got two possible responses, I guess. If you're feeling grumpy, you can say, okay, now let me be sure I understand this. You're telling me that your assets are understated because on the balance sheet here, because you don't have all of the intellectual property and the R&D and the patents and all that kind of stuff. And they say, yeah, our assets are understated here. So you say, okay, so your assets are understated. Your liabilities presumably are stated 100 cents on the dollar. You don't have those understated. So no. So you say, okay, understated assets minus fully valued liabilities. So that means your shareholders' equity must be understated, in a true economic sense. And they say, yeah. So then you say, well, in that case, if you've got all of this intellectual property working for you, then your return on accountant's equity should be obscene. I mean, you're making all of this return on this intellectual property value that you've been investing over the years. And then I'd say 8 times out of 10, they get kind of fidgety. Because if you calculate the return on equity, it's like 6%, 8%, 10%. No big deal. And so when people talk about the intellectual property value they have in the business, the intangibles, I got no problem with that. But if you have that, and it's earning what it's supposed to do in terms of an economic rent, then it should show up in a supernormal ROE. And if it doesn't, I think the burden of proof is on them to say, where that hidden intellectual property value is. So that, as I say, is one response. But what if they do actually have a high ROE? I mean, Budweiser has a 58% return on equity, I think. Most drug companies in the U.S., the Pfizers and the GlaxoSmithKlines and the Bristol-Myers, have returns on equity 25, 30% or more. So clearly, if you do have a high return on equity, maybe you shouldn't be expecting to find them trading below collateral value per share. That's not realistic. So we need some way of saying, okay, I'll pay a little extra. I'll pay a little bit more for higher sustainable growth. So step one is to figure out what am I going to use as my proxy for sustainable growth, and then step two is to say, well, how much more is okay. So with step one, then, how are we going to figure out what's the sustainable growth rate? I mean, what's the driver, the determinant over the long run of a company's sustainable growth? Yeah, but how does that get demonstrated? I'm a numbers kind of guy. Competitive advantages, I mean, that's the stuff that the CEO talks about in the president's letter, at the front of the annual report. But what number would I go with? Yeah. That's true for companies in general, but now we're looking at our particular company. So one particular company. Yeah, well, okay. In the industry, yeah, we're narrowing down. Why wouldn't we get even more specific and say the company itself? And not what the management or the CEO says they will grow at, not what the sell-side research analyst says they'll grow at. I look at the return on equity. I mean, return on equity, if you've done your CFA readings, that's where you get your sustainable growth, right? ROE times 1 minus the payout ratio. So if you've got a 0 payout ratio, ROE, other things being equal, no other changes, ROE is the upside to your sustainable internal growth, right? Everybody on side with that? Okay, good. So what we could start out with then is ROE, which is why when I was talking about paying a premium for drugs companies or beer companies, I said these guys have 23, 25, 30% return on equity. And if they can sustain that, sure, we'll pay 3 times book value or maybe more for something that can sustain that. So return on equity, I think, is the number that we'd like to zero in on when we're doing our research to figure out what's a sustainable kind of growth rate. And what determines return on equity? Well, I guess a bunch of things do. What I like for that is the famous Dupont Formula. To me, it's famous anyway. I don't know about you folks. So Dupont Formula, return on equity, I'll move that up so we can see it, is a function of asset turnover, which is sales over assets, financial leverage, which is total assets over common equity, pre-tax margin on sales, pre-tax income divided by sales, and the tax rate. And we need to know all of these components and more, ideally, because, as I say, we're saying that the return on equity is going to be the driver of future growth for a company. Certainly it's true for the industry, but for the company, because we're interested in investing in a particular company. And so we eventually have to zero in on that. So that's why we're interested in the return on equity for that company. And so lots of people say, I got this finance book and it's full of ratios and I've calculated all the ratios and I don't know what to do with them, Or I don't know which ratios to calculate first. The damn book is full of chapter after chapter of liquidity ratios, leverage ratios, profitability ratios, turnover ratios, And nowadays with a computer, of course, the computer calculates them all for you, but you still don't know what the hell to do with them. So the Dupont Formula is, in my judgment, your starting point. And if your boss, when you get a job, says, do a quick and dirty analysis on this to see if we should pay any, do some more homework, I think you should do the Dupont Formula. And because you quickly see how profitable is the company, the return on equity, and how did they get there? Because Bear Stearns, for example, had a very high return on equity. I don't have a clue about any of these other numbers, but I do happen to remember what their financial leverage is, which is assets, remember, divided by common equity. Typical company in the industrial business, if you got $2 of assets for every $1 of equity, your banker would say, that's enough, That's kind of leveraged if you're making widgets or laser equipment or stuff like that. Guess how many assets Bear Stearns had for every $1 of equity? 31, okay, yeah, 31. So, there's all this talk about what brought Bear Stearns down, and a whole variety of things brought them down, but when you got $31 of assets for every $1 of equity, you don't have a lot of margin for error. And so the specifics of what brought them down, I guess you can argue over, but I'd say, and similarly that one, Carlyle Capital Corp in Europe that was unable to refinance, they too had $1 of equity, $32 of assets. So yeah, some companies may have a high return on equity. Anheuser-Busch, I think, as I remember, has a very high return on equity because their leverage is through the roof because they keep buying back shares. And you may say, well, that's okay for them because beer consumption is sustainable. It doesn't go down, it doesn't go up. Maybe they can afford to be leveraged. But that's a judgment that you get to make. But it's a judgment you can only make after you've analyzed the components of return on equity. So let's do that. And I've got some samples here. And I think it's always fun to do it when we don't know what the company is because then we learn more. So here's the Dupont formulas for, let's see how we're doing for time here. Okay. We'll do it for at least a couple of the companies because, as I say, this is what you should do when your boss says, let's look at this company in more detail, maybe. You need to know what ratio should I start to calculate, what questions, if I get to see management, should I start asking next. And the key to know where to go next, because, as I say, the book is full of ratios. So you need to know where do I start zeroing in and where can I say, well, on the face of it, that's not an issue. And so you do the Dupont formula year by year. You do it across 1 year and then back for probably, I happen to have 8 years of data, so that's what I use. I think much more than 10 probably is overkill. Not so much overkill statistically, but if you go and actually visit a company and speak to the chief financial officer, if you talk about a period back in the early 90s or the 80s and say, you know, could you achieve those levels of profitability again? You know, usually the pre-tax margin is what's changed a lot. And if you ask them, could you go back to those levels of profitability? Most of the time they just laugh and say that was a different era, you know. Depending on their business, they say, oh, well, that was before Walmart. That was before, you know, import competition from China and Vietnam and Sri Lanka, whatever. That was before, I mean, the world has changed so much in 10 years, I'd say it's interesting but probably irrelevant. But probably you need to do more than 4 or 5 years because most companies have actually been on something of an upswing in the last 4 or 5 years. So you go back maybe 8 or 10 years, but certainly I wouldn't do more than that. Return on equity, asset turnover, pre-tax margin, tax rate, and financial leverage. So this company A, pretty stable, stumbled recently, so, but pretty high return on equity, I think you'd agree, 20, 22, 24%. And then even the 16% isn't bad. Asset turnover, well, dropped quite smartly here. You see the financial leverage jumped as well, so probably they made an acquisition. You know, they borrowed money, the financial leverage went up, the asset turnover went down because they acquired something part way through the year and they didn't get the revenues. You'll see that's picking up again a little bit, but not back to the prior level. So if you're driving the valuation model with something that's a function of return on equity, then I think when you get to see management, your questions would be, by and large, do you think you can get your asset turnover back up? Because, you know, the margins are pretty much back to the levels they were back in the glory days of 22% return on equity. The financial leverage is back to normal. So so now we know where we want to ask the question, you know. What about your asset turnover? Is there change? Is it logistics? You know, what's been the big change? This company is Metro Inc. It's a supermarket chain. You can tell, well, you can't tell. The clues are stable profitability. This is pre-tax margin, don't forget. So the after-tax margin is around 2%, which is what you'd expect from a supermarket. Reasonably rapid asset turnover. Tax rate is legitimate. And so the key for them, Metro Stores acquired back in this year AMP, Dominion Stores. And so they took on big additional assets. And so that's why, for them, the key will be to get that asset turnover back. And maybe if they've grown from being a big regional player to being a national player, maybe it will never go back there. I mean, that's a judgment that you'll have to make as the analyst. But now, at least, when you look across here, you have an idea of where do I want to zero in on my questions to figure out what's going to drive ROE, because that's going to drive my growth rate assumptions. So that's a pretty stable company, which is what you'd expect, a supermarket, you know. Every week you go and get some bread, some milk, some yogurt. You know. The next one, company B, what do you think this is as a company? Sorry? Yeah, well, it could be. It's all over, it's barely, you know, it almost went out of business here. If you have a minus 75% return on equity, you know, 6 more months like this and you got zero equity. The pre-tax margin's all over the map. The financial leverage, I guess, is relatively low. This is actually Breakwater Resources. So it's a junior resource stock, heavily leveraged to zinc. The reason I think they were able to survive back here was that Dundee Corp is and was a significant shareholder. So they kept doing rights issues, and Dundee Bank Corp would backstop the rights issues. So they were always able to stagger through one more year, until finally the price of zinc took off, and their ROE went from minus 70 to plus 70. So resource stocks, this is maybe an illustration of why you don't usually find many resource stocks in value investors' portfolios, because it's kind of tough to know what the right number is. I mean, you can always average these numbers, but you know, that's not a useful exercise, I think, when the distribution is that wide, to say the average, you know, comes up the middle. They never earn the average. They're either at one extreme or the other. But that, as I say, the resource stock is maybe a good example of why value investors have a tough time getting to grips with that, because you're not sure, you know, what numbers to calculate. Company C and D. Well, Company C, high return on equity. Obviously, they had a problem one year. That was the year when they presumably had some major write-offs, because all of the problem occurred, the asset turnover remained strong. All of the problem occurred in the pre-tax margin. So they lost money that year, probably as a result of inventory write-offs or something of that nature. Tax rate surprisingly low, which helps the ROE. So maybe you don't feel quite as good about that ROE. You know, qualitatively, it's not as good as it might be for another company. More recently, things seem to have deteriorated in terms of the pre-tax margin, and the tax rate is beginning to creep up. So the combination of that is bringing the ROE down. So again, the history is interesting. The little breaks in the history are particularly interesting. And if we have to forecast the future growth rate, we might be a little reluctant to be using that 20 to 30% return on equity as being a sustainable number, because something funny has been happening recently. And this is Cryptologic, which provides software for online internet gambling, which in many jurisdictions is illegal and can get you arrested if you happen to stop over in the US. And the guys in Customs and Immigration figure out what you do for a living. So maybe things have changed permanently for these guys. Now here we aren't addressing value. I mean, it may be that if the stock is trading below cash value, you say, so what? But at this stage, we're trying to figure out what is a measure of a sustainable growth rate. And the final one, company D, this is actually quite topical. Very high and very sustainable, actually improving return on equity. And boy, not a blip on the horizon here. So this has been a great company, clearly in a strong growing industry. Weird low asset turnover, so clearly this should be a clue as to what the industry might be. Pre-tax margin is obscene, so obviously they're selling to customers who aren't in a position to shop around. Whatever service they're selling, they don't have a lot of competition for that particular product, because they can charge whatever the money will bear. Tax rate is legitimate, so that's not the issue. Financial leverage, high, so that's the other clue. These two should be clues as to what industry we're in. Sir? No, the leverage is would be scary for high tech. Well, we're getting there. It's somewhat regulated. But yeah, it could be. Well, it's finance, actually. Generically speaking, finance would permit this kind of leverage, although not all. Griffiths McBurney and Canaccord would have a financial leverage number of 3 or 5 times. These guys, this is home capital. So they are the ones who make loans to people who don't qualify at the regular bank. And so that's why they Now, look, it goes right through to December of 2007. So you can't say, and Canadians maybe will keep their houses longer than Americans. And the anomaly apparently with Americans is now they default first on their mortgage, then on their car, and they keep their credit card current as long as possible, which is the flip side of what is normal expectations if you're in the credit collection agency. So I don't know. But there, I guess you have to make a macroeconomic call, because there's nothing statistically wrong with these numbers right to the end of December. And so, presumably you would start monitoring not so much maybe their defaults, but their loan origination. Can they keep building the assets? But now again, you have some idea of the kind of questions to ask. But clearly, in those margins, they've gone from 22% to 36%. That's really quite. Now, in a financial institution, margins have a different definition, but that's an astonishing margin. But I guess it reflects the fact that their customers don't have a lot of choices. They've been turned down by the 5 national banks, and now they're at home capital. So I don't know where the next step would be. The McTamney's pawnbrokers on Queen Street in Toronto, maybe. But no, you see, this is for mortgages, and I believe the quality of their mortgages is, in fact, thus far, is good. It's not that they have foreclosures or things to worry about as an investor. So that's the sort of message that you extract when you're looking at a bit of a history of the return on equity for the Dupont formula. Okay, so with this analysis, you're now in a position maybe to come up with some logically defensible argument as to what the sustainable growth rate would be for this particular company, going forward. You've looked at the history, you've wondered how will the history change in the future, and your ROE number is your driver. And so what are we going to use here? We're going to use ROE times 1 minus the payout ratio. So that gives us our internal growth rate plus the dividend yield, if any. And so that's good. So that's half of the equation. We know we found a company maybe with an above average expected internal growth rate, let's call it. Now we have to figure out how much can we afford to pay for it. And so that's where the next little step in my methodology comes in. And this is what I'm calling here the investment growth rate schematic. And once again, so let me just show you there, investment growth rate schematic, and here it is. And once again, I'm not a very original thinker. I just happen to pick up good ideas from other people and say, maybe I can tweak this and and arrange it to my benefit. And this is something that is really old economy. It was when I was at Confederation Life, so we're back into the 70s. And we were managing money for the American Airlines pension plan, the Canadian employees of American Airlines. And it was interesting, the manager of the pension plan, the American Airlines employee, had multiple managers, which was the norm in those days in the US. And so he didn't have any real way of knowing all of the stocks and all of the portfolios of all of his managers. And so if they said they were growth managers and they showed him a portfolio, he didn't know. He had no way of knowing it. And similarly, when he came to Canada, of course, since he was an American, he had no idea even what the companies did for a living. So we couldn't have told him anything. And so the way he tackled that as the manager of managers was he said, I want you to categorize all of the stocks in my portfolio, my pension plan, according to the investment growth rate, IGR, he called it, schematic. And so we essentially had to do that, and that way he could see if you said you were a value investor, where the bulk of your stocks actually clustered there, or were you actually talking up value but buying a lot of wild growth stocks. And so this is how the system works, and it's a very good mental framework, even if you don't actually meticulously place companies to 2 decimal places in this. The investment growth, the IGR, is your internal growth rate on the vertical axis. The center point here of the axis, I think, and what we use as the benchmark, is the TSX. Because you can buy an index fund if you don't know what you're doing, or even if you do know what you're doing, you might choose to buy a low MER mutual fund or index fund or ETF. So that's your default case, and so that's right here. So here you would put on the vertical axis the expected internal growth rate from the typical or median company on the TSX. And so for that we need to know what's the return on equity for a typical company on the Toronto Stock Exchange. And the answer is return on equity. Okay. Is it 2%, 8%, 10%, 12, 20? Okay, let's hear from the cheap seats in the back row. Okay, yep. 15%. Yeah, pretty good. Low double digits. Yeah, you're in the right ballpark. The average for the last 5 years is 14. So you're right on the button. The average for the last 10 years is 12. So that tells us that the first 5 of the last 10 was actually, 10, right? Because 10 and 14 averages out to 12. So you can argue it's 12, you can argue it's 14, you can argue that the most recent 5 years are maybe a particularly positive environment, so maybe we want to be a little closer to 12. So we'll say 12% ROE plus or minus a bit. About a third is paid out as dividend, so two-thirds is retained. So 2/3 of 12 is about 8 and a bit. The dividend is another 2.5 or something like that. So we're up around, this number here would be around 12%. Okay?
So looking at the retention rate, aren't companies use a lot of their cash for share buybacks, kind of similar to dividend in that it's not really from a growth thing. So
yeah.
Would you normalize that out when looking at the retention rate?
I wouldn't for the TSX because I'd say that's aggregated and it's not big in the in the context of what I'm trying to do here. For an individual company, yeah, that would be an important factor, and that's why, for example, companies with very high returns on equity don't fit this model very well. Like, I come back to Anheuser-Busch, and they've got a 57% return on equity. They've got financial leverage up here because they've been buying back, exactly as you've been saying. So their ROE is astronomical, not because beer selling, making and selling is an astronomically and obscenely profitable business. It is if you're leveraged up to the eyeballs, And so you're right, that's where, fortunately you won't be replaced by a black box because you've got to be able to say, the numbers say this, but the reality is I don't feel good about the numbers. But for the industry aggregate, for the overall Tsx Composite, I think, you have to make some decisions also on things like, do I want to use operating earnings, or do I want to use reported earnings? Because if Bell Canada has a big write-off one year, then it's big enough to distort the ROE for that year for the TSX. Then you have to say, well, how do I want to handle that? Because I don't think you want to ignore it, because, all they're really saying is we didn't make as much money as we thought for the previous 5 years. We're taking a big bath this year. So you shouldn't ignore it, but somehow you have to normalize for that. So on the vertical axis, the number would be about 12%, let's say. 8 or 9% reinvested, 2 or 3% dividend yield. The PE ratio, the normalized PE ratio is, maybe 18 or 19 currently. You can derive that the same way actually by saying, well, if my ROE is 12 or 13% and the price to book right now is about 2.5, then you can actually derive what the normalized price-earnings ratio is by mathematics that don't even cause me to break a sweat. So you guys are going to have no problems figuring out how to get from price to book, ROE, to normalized PE ratio. So that would be your horizontal axis. So now we've got our schematic ready to go. So now when we're looking at individual companies, we do our Dupont calculation. We go back 6, 7, 8 years to come up with enough history to come up with our forecast of what might be sustainable into the future. So we know our IGR for the particular company. We calculate also the normalized PE ratio. Not this year's PE ratio, not next year's PE ratio, and certainly not what the sell-side analysts do, which is the PE ratio on fiscal 2010 earnings, because by that measure, everything is cheap. So we don't want to go there. We're using normalized PE. And so we put it in one of these quadrants. And so let's see how smart you are. Which quadrant would you prefer to have most of your stocks clustered in? One, okay. That's correct, because you have a higher expected return and a lower PE. So you're getting, boy, I mean, this is a real deal, right? You're getting better, you hope, growth, and you're paying less than the market multiple. Now, for an individual stock, you're almost certainly going to be wrong by some order of magnitude. You just don't know how or why you're wrong. But you would want, and back to this guy from American Airlines, he said, I don't know the names, I don't know what the businesses are, I just want to see you, and you can use your own numbers. I want to see where they're clustered, and I want to see, if you say your value, I want to see that most of the names are clustered here. And if all of them are clustered here and they look like, bargain basement time, then you can say, well, show me your calculations. And show me your ROE assumptions that drive the IGR. And then you can say, well, show me the history. And if you, because you can, once you've figured out this system, it's pretty easy. You just keep cranking up your return on equity forecast until everything's in this quadrant 1. And you say, I got that guy fooled. Well, then all he has to do is say, show me the last 10 years. And if he says, okay, this company in a good year in the past earned 14% ROE. When everything was firing on all cylinders, their peak year was a 14% return. And you're telling me they're going to earn 18% going forward, which is why it's a quadrant 1 stock. Show me how. Why? Are they going to do it with financial leverage? Are they going to, pre-tax margin? Show me how. And if you can't show them how, you're toast, and they hire another pension manager. So that was the American way. But it made a lot of sense. So now this is the interesting quadrant. How about this one? I kept saying the nice thing about this methodology is it permits you to say, I'm willing to pay a little extra for something of incremental growth. And so here, if you're in this quadrant 3, we've got incremental growth expectation and a higher PE ratio. So you can actually plot a line, which would be kind of upward to the right here, that essentially you could decide what would be a reasonable payback. You can say, well, I'm willing to pay, a 10% PE premium if I can earn that premium back in 3 years or whatever. And so I'd pay a 30% premium for 10% incremental growth, or a 6% premium for 2%. And your line, that would be your 3% payback. Or you could say 5%, whatever you like. And so that would be one way of making sure that you're staying with the program. You're saying, I'm willing to pay up, but I'm not willing to pay too much. Like a 5-year payback, I can imagine living that long. Longer than 5 years is, I'll have a new career by then. So that would be how you would tackle it. And then you back off and say, well, how confident do I feel about my IGR number? Well, that's a function of your return on equity. So it's all very logically, laid out and all very defensible, really. So this quadrant is often occupied by value stocks. What do you think many of the stocks in this category, in this quadrant, are? These are often value traps. You've heard about value traps. These are companies that are cheap. They're trading at a small discount to book value, or 6 or 7 times, PE or cash flow or whatever. And they're just doomed to stay there the rest of their life. Best example I can think of is wholesale distribution. That is a dumb bit. Well, it's an important business and it's a major contributor to GDP, but you don't want to be in that business. Because there is no goodwill in that business, because their return on equity, if they're doing it really, really well, is 8, 9, 10%. So they're worth about book value. And that's, we've lost more money in wholesale distribution businesses than you can shake a stick at. And it's because, as I say, there's no real, there's logistical value added, but there's no other visible, value added. The margins are so small. One of them, did, I think, $300 million worth of revenues, and the bottom line was so small, I swear, if they changed the depreciation schedule on the company car, they would have gone from a profit to a loss. I mean, that's wholesale distribution. You just don't want to be there because there's no upside. If you buy it maybe at 50% of book value, maybe it'll go up to 85%, but maybe it won't at all. So, as I say, Quadrant 2 is full. Sadisco Howden was the company that used to be somewhere in this part of the woods. Shermag. No, we visited Shermag, and that was bad news, but that was for a different reason. That had old economy facilities and what have you. But no, wholesale distribution is a good example of, you'll find lots of stocks clustering here, and don't go there. Yeah, exactly, and that's a different business model. And so if you did your Dupont Formula, you'd say, well, this is interesting, but it's completely irrelevant. We're now in a different business. And they're doing, like furniture brands in the US is doing the same thing. They've offshored the manufacturing, and they have brand names like Shermag, except Broyhill, and I forget what else. So it's a different business model. You have to have higher asset turnover, lower margins, a whole lot of different calculations. So this is I'm not saying you don't want to have any stocks in here, but you don't want to have too many, and you want to have a good reason as to why they're there. Do you want to have any in this category? Quadrant 4? Not normally. I mean, there may be a reason. You have to have a special reason as to why. You may say, well, these stocks in this industry trade on the basis of appraised value or something like that, or whatever, and so the ROE calculation isn't relevant. So anything that shows up in here, as I say, it has to be a special situation of some kind that you have to be able, I think, to articulate clearly what makes it, unusual and what makes it that special situation. So you can see here, though, all of a sudden you got a way of classifying companies in terms of the ones that are the most attractive, at least based on your input, the ones that are... Now, Quadrant 3 actually is a good area because it permits you to politely give people the brush off because you can say, when people come in with their great story on their great company, high return on equity, high growth rate, everything is looking good, but the PE, research in motion, imagine where research in motion is. It's presumably somewhere, off the chart here. Legitimately, I think its expected investment growth is high. The PE ratio is, infinite or whatever. So you can say, and as I say, you can politely give people the brush off because you say, great company, wonderful management, you're doing a superb job, great company, lousy stock. And that's not a personal affront, it's just the valuation judgment. So there's no reason to dismiss or ignore, Quadrant 3 at all. It's a good way of categorizing, as I say, companies according to their growth potential and how much you should pay for that. Now, I said, I tell you why you aren't going to be able to successfully do this, most of you. And then I'm just going to finish up with one other deep value stock, which is also headquartered not too far from here in Brantford, which has outlets actually here in London, and with whom I made a special deal this afternoon. I went by and I did a deal for the first 50 people here to go by. They'll get a free gift. So you can imagine this is a retail, and unfortunately they don't sell alcohol. But I'm saving that for the last slide because I want to be sure that people don't start sneaking out early. So why do I think you won't be able to do it? And as I say, it's not because you aren't smart. I mean, for heaven's sakes, here you are at Western, right? So we all know you're smart. It will be partly to do with the psychology of yourself, because people like it on paper, but when they have to do it in the flesh, it doesn't seem quite as good. And also the reality of the organization for which you work and the clients that you have. And this is a good example in Canada of why it's tough. There's an assumption, I guess, that value investing kind of always works. You just buy cheap stocks and they go up and your clients are always happy. Here we are. This is growth versus value, relative total return within the S&P Tsx Composite. So these are the big cap stocks. This is from BMO Nesbitt's chart book, and they update it every month. And they're saying within the TSX, what's hot and what's not. And they're just simply saying we're going to define growth stocks as being the top, I guess the top 75 price to book stocks. They just rank them by price to book, take the top 75 and say, okay, we're going to define these as growth stocks. We're not going to get in a long discussion as to whether that's the best or the only. It's not the only. It's probably not the best criterion, but it's the only one that they can readily use. So the top 75 price to book stock companies are defined as growth stocks, and they plot the performance of them month by month. The bottom 75 price to book are the value stocks, and they plot the performance of those. And this line is just simply the relative performance of growth versus value. So when the line is going up, it means growth stocks are doing better. The whole market could be going down. It just means that within the market of big cap stocks in Canada, growth stocks are doing better. And you'll see it just bumbled along. You know, you could make money being a growth or a value investor through the 80s and the early 90s. And then as the 90s got underway, you see this parabolic takeoff, right? And remember, those days, that was Nortel, JDS Uniphase, that was the internet bubble. Growth was the only place to be. So growth stocks just outperformed. This was when Nortel, remember, was 30% of the Tsx index. Now imagine you don't own any Nortel. Back in those days, well, then still, mutual funds and pension funds, the regulations say you can't have more than 10% of the assets invested in the securities of any one issuer. So there's a lot of whining going on in the investment management community back in those days because they said, how can we compete with the TSX? That's our benchmark. We can't have more than 10% in Nortel, and it's just going straight up, and it's 30% of the TSX. So, and on the OSC, actually they did them a favor. The OSC dragged its feet and said, oh, we'll have to think about this for a while, and they dragged their feet some more. They never got around to changing the rule, which is good, actually, because by the time they would have got around to it, it would have been the time, you know, would have been round about here, I guess. So the investment management business was saved from its own stupidity, but that was the high value investing. And as I say, imagine not owning any Nortel, and you think you could have kept your job for a while, kept your clients for a while. You could if you were a small firm. You know, if you're Francis Chu, you just say, so what? You know, you don't do much marketing, and you say, you know, Nortel is not a value stock, you know, end of discussion. But if you're working for a big firm, you know, in the early days, presumably your boss would come into your office and say, well, tell me again why you don't own any Nortel. You know, and you'd say, well, it's not a value stock, and these are our criteria, you know, IGR, Quadrant 3, blah, blah, blah. You say, oh, okay. And the next quarter he'd come by and say, you know, we're now edging down into the fourth quartile, and tell me again why we don't own Nortel. You say, well, you know, value investing, price to book, price to sales, you know, Quadrant 3, IGR. You say, oh, okay. You know, now we're into the third quarter. You know, the boss comes by and says, well, we're deep in the fourth quartile, you know. The sales force is yelling and screaming because they can't sell anything, you know. We're losing clients. People are yelling at me, you know, I'm not real happy. You know, don't you think we could own a little bit of Nortel? You know, and that's why I say maybe you've got the intestinal fortitude, but you have to be sure that your boss and your boss's clients and your boss's boss and all those people have the intestinal fortitude, because otherwise, you know, you're not going to be able to stick to the program all the way up to here. Now, we didn't own any Nortel all the way through this time. Now, I wasn't then and still don't manage the large cap portfolio. That's Rick Howson. And when people say, well, how did you manage that? I say, well, actually, I don't remember. And it's not that I have amnesia. It was we were a much smaller firm. And Rick and I were the sole owners. And I guess in retrospect, we didn't make very many presentations. We certainly, I don't remember getting a lot of clients. We probably kept most of the clients we had, but a few private clients, I think, left. But 10 years ago, I don't remember. But we were able to do that because we, like Francis Chu, we were a small firm. And, you know, we were determining the future course of the business. We had one marketing guy. And that year, he didn't get a bonus. Because, I mean, how could he? But we didn't have a whole raft of marketing people out there whose job is to gather assets and do all of the things that financial institutions do. So, yeah, you're smart, you're hardworking, you believe in value, but as I say, there's extrinsic factors that maybe discourage that from happening. That's the situation in large cap. The bottom panel is the same situation. This is within small cap. And so there was no Nortel in here, no JDS Uniphase, but there were the small cap equivalents. Same spike. This is a shorter time frame. That's why it's not lined up the same. But exactly the same phenomenon. It's and again, I don't remember doing many presentations in the late 90s because we were, you know, presumably at the bottom of the fourth quartile. But I don't remember that because we didn't have a marketing guy yammering in my ear about I was not getting a bonus this year. So that, as I say, is a factor of economic reality. If you think that was just Canada, you know, it was only the wacko Canadians with their Nortel. Nope. The same two panels here are for the U.S. The top one is the Russell 1000, which It's not the biggest of the big caps like the S&P 500, but these are pretty damn big companies. And these, again, excuse me, are the same internet blow-off, the same spike there in the growth stocks, and then dribbling away for the last 8 or 10 years have been very much, when the line is going down, it means value stocks are outperforming, which is good news if you're a value investor. So sometimes it's probably more important to be lucky in terms of your starting your career as a value investor, because if you start your career round about here, the next 3 or 4 years are going to be, tough sledding before you finally get vindicated. But then when you do, when the tide turns, you'll see a very significant, these are the U.S. small cap stocks, Russell 2000. So that probably is the most significant factor I can think of that discourages people from value investing, is it doesn't work all the time every year. The other reasons are you're not much fun at cocktail parties, because when people are standing around with a drink in their hand trying to chat up the members of the opposite sex, and they say, well, I'm in investment business. If you're a growth investor, you talk about research in motion and BlackBerry and all this kind of stuff, and the people are just hanging on your every word. If you're a value investor, you say, well, I've got this stock and it's a discount to book value, and it trades at 6 times EV to EBITDA, And I think maybe they'll break even next year, and maybe the year after that they'll grow a bit. Pretty soon people are saying, oh, I'm going to get another drink. Those sandwiches look good over there. You're not exactly the center of attention. So there's a big psychological barrier. I mean, some people just don't like, because it's not all that sexy. Well, actually it is. I mean, Vertec, I was pretty excited. I mean, if you're a value investor, that's the sort of thing that gets you excited. You find a stock below book value, below net working capital, below collateral value per share. Half of it is in cash. I mean, really, that should, if you're a value investor, that gets you excited. But for the most people, that would not make you the center of attention, at a cocktail party. So, that is the other, intrinsic, I guess, issue that a lot of people just aren't psychologically equipped for value investing. I said I'd finish off with one other example. It's not quite below that collateral value per share, but it is below book value, and it is below net working capital per share, and it's pretty close to collateral value. And the deal is the first 50 people out of here, and they don't close till 9 o'clock, the first 50 people out of here get a free gift. All you have to do is mention my name and you attended the class, and I think there's a choice of gifts. George, you better leave now, because it's only the first 50. And so let's disclose it. The consolidated balance sheet, same kind of methodology here. The collateral value, it didn't quite come through, but I'll remind you again one more time. They don't have much cash, okay? So that's why you need to go down, spend money. $216,000, that's a bit scary, okay? 100 cents on the dollar. 75 cents on the dollar for the accounts receivable. They don't take credit cards, right? This is a cash business. Lots of inventory. Okay, 50 cents on the dollar for the inventory, so that's about 25 million. The fixed assets, well, it's pretty dumpy looking stuff actually, but 12 million. Total there is, where are we, 25 million? Well, I'm understating, boy. Dramatically understating. The bank debt is 8 million. And so, where are we? Book value per share is 490. Let me just move down here a bit. Yeah, where do I get that? It should be 35, not 25, right? 36, yeah. Okay, well, boy, that's poor arithmetic. Well, in that case, this is even more exciting, to underestimate the value here. Oh, boy. They only have a small amount of bank debt. The book value per share, you'll see, is 490. The net working capital per share is 336. The collateral value, if this is 36 minus 8, we're looking at 28 divided by number of shares outstanding. The collateral value per share is over $3. And the company, stock price trades at 250, and the company is Liquidation World. So they have 2 locations here in London, but I only did a deal with the guys at the 401 and where is it, Wellington, or what's the main street that goes up and down? No, it crosses the 401, and the Costco's on the same street. Wellington. Yeah. Okay, so you go to Liquidation World at Wellington and the 401, and you can buy, but this is astonishing, really. This company, as you can imagine from the name, it liquidates other people's mistakes, and so what they paid for their inventory is a fraction of what its retail value is, and you in turn can buy their stock at a fraction of what the markdown value is of their liquidated inventory. So unfortunately, it's been this way for quite a while. I have to admit, liquidation world is probably a value trap. Francis Chu and we own it, and George Ormoyan, I guess, is another guy that owns it. And so we have lots of well-known value investors who are looking for an exit strategy here. But but I can't bring, unlike Vertec, where I think you could actually make money if you bought the whole company. Here, I think our best exit strategies for all of you guys before 9 o'clock is to get down there and get your free gift, because well, what's wrong with it? Statistically, it's very cheap. It has a very if you do a Dupont Formula, it's very erratic the last few years, and so you can't really make anything intelligent out of that. The problem, I think, for Liquidation World is that the world has changed for them. They started out as a regional specialty retailer in Alberta with an entrepreneurial guy, Dale Gillespie, running the place. And he had a very hands-on approach, which makes sense if you're running what's essentially a glorified garage sale. I mean, really, it's like a church bazaar rummage sale. And you can do that if it's regionally local. I'm not sure you can do it nationally. And also, if you go back 20-odd years ago, the big department stores in those days didn't do their own liquidation, which now they do. They have, you go to the Bay, and every weekend you can do scratch and save and what have you. Also, you didn't have dollar stores. So I think maybe the world has changed for Liquidation World, and maybe in a permanent way. So we're not too sure what the outcome is, and it may very well be that it remains, a value trap for some time. It's certainly, if you honestly put in your IGR numbers, I think you have to admit this is a Quadrant 2 stock, deep in Quadrant 2, and it may take a while to dig its way out. Okay, so that's my contribution to this evening, and I think George said it would be good if we had time for Q&A.
There's a microphone over there.
Okay.
So that you can take your questions. So please come over here.
Or I can repeat the question if that works as well. Yeah.
How does your analysis change when you're looking at a non-asset-based business with a high return on equity? So like a bond rater, a research firm, or a consulting firm?
Yeah. It's problematic if you're looking at something like a Moody's or what have you, or a company of that nature, or an investment counseling firm like Saxon Financial as an example. High return on equity, negligible physical assets. It's a practical matter. I suppose if you look at our portfolios, you say the answer is we'd finish up by not owning them, because we just simply cannot chin ourselves up to believe that this is sustainable. I mean, you look at the numbers and you say, I know they've done it for 10 years and there's no reason to disbelieve this, but if we were more pure, I guess, and if we were truly statistically driven, we'd say that's the way the world is, the ROE on an investment management firm. In fact, we do own Canaccord, and we don't own GMP, and we pay, I think, 3 times the book value for both of those, because we're saying the sustainable return on equity for those guys is high, and we're willing to, we've chinned ourselves up to do it, but it's a bit of an emotional barrier to go over.
Did you buy them a year ago? Or?
Yeah. No, we bought them recently. Canaccord we bought recently when they started getting lawsuits against them because some of their clients were put into asset-backed commercial paper, which their clients say, was the responsibility of Canaccord. Past experience says that brokerage firms never ever refund anything to their clients, and so I don't think they're going to have to pony up for that. But they have a lot of cash, and based on our back of the envelope calculation, and based on the Crowford committee potential discount of 20 cents on the dollar for asset-backed commercial paper, our worst case scenario is that if all of the clients' asset-backed commercial paper was written down to 80 cents on the dollar, and Canaccord, for some bizarre reason, actually had to pay that difference, that they could still do that, and they'd still have a significant amount of book value remaining on the balance sheet. Okay.
I feel the next question, I guess. What is the database is usually used to come up with all these ratios? Is there a specific database you?
Yeah. The net working capital one, we used Bloomberg. And then we have to do a fair amount of cleaning, because if you use the normal definitions for net working capital, it tends to throw up a lot of financial institutions, because the formula thinks that all of the cash in the bank belongs to the bank, and it doesn't realize that it should be offset by deposits. So you have to do a moderate amount of cleaning and just eliminate the financial institutions. Cheaper though, much, much cheaper, is something called stock guide publications, which is, it's more stale dated data, but you get a CD-ROM once a month with an updated price file, and I think that's something like $1,200 a year. The only trouble is the data tend to become more and more stale dated as you go through the year, and it's called stock guide publications. Yep.
Hi. Has your screen pulled up a company called Gemtech?
No, but I assume you own it.
No, it just passes your valuation method.
Okay, is it listed on the Venture Exchange?
Yes.
Yeah. Well, I say no. And it doesn't sound familiar. The last screen we did, which I think included Venture Exchange, there were a lot of really, really small cap companies, even smaller than Vertex, for example. But the bigger names that showed up were Jump TV, which spends $14 to get every subscriber and get to $11 worth of subscription revenue, so that's not a good business model. They went through $20 million of cash last year. West Aim, which used to be iFire and stuff like that, which were the other big names. But then there was a whole raft of small names, and it may very well be that it was on there. What's the market cap?
If I recall, it's right above 10.
10, yeah, okay. We may not have bothered to do any more homework on that.
I've actually got two questions.
Yeah.
First one is, when you've got a value fund, typically to be able to achieve that catalyst, there's often an amount of time that you have to wait. So how do you, as a senior portfolio manager and owner of the firm, meet your float? Because I've heard of some funds where they'll go through, let's say, like day trading, technical analysis, so that they're able to meet their overhead, able to pay salaries and stuff like that. So in a value fund, is it just park some cash and then use that to pay any expenses, or?
Yeah. Well, a mutual fund typically charges a percentage of the the value of the portfolio on an accrual basis, calculates it every day. It's I guess the daily equivalent to something like 1.75 or 2.5% of the market value of the portfolio. Accrues it during the course of the month as a liability, and then at the end of every month pays it out. And so you always need to have, I guess, a small amount of cash in the portfolio to pay that out, but you don't need to have a meaningful amount that's, I mean, even if you had a whole year's worth, that would still be, for us, less than 2% of the value of the portfolio in the form of cash.
And the other question I have for you is, I understand with small caps this might not be relevant, but with a larger cap stock, if you've got a value that you've identified as potential value, rather than buy the common, is there ever an instance where you buy a derivative instrument, like buy a long call, and sort of take advantage of? Yeah.
We've not done that. Logically, you could. I guess our misgiving with doing that is that we think we have a reasonably good skill set in determining value, but we're never sure when it will be recognized. And with any kind of call or a derivative, it could happen the day after. I mean, that's what always worries us when we think we have a value trap. We think we should get rid of it, and then we think, no, because the day after we sell the damn thing, somebody will take it over. And that is our misgiving with calls and options and warrants even, that you may be right in principle, but your timing is, usually the timing is too short, because we have a turnover rate of about 25% in the portfolio, which implies an average holding period of 4 years before they go out, and that means that's much longer than most derivatives exist.
Thank you.
Okay.
Hi. What kind of management screening or evaluation do you do?
Well, I somewhat facetiously say, as long as they're not visibly drunk and they show up for work every day, that's about all you need. Because really, with value investing, you've done a lot of statistical numbers, beforehand, and so you've said this company is statistically interesting. And so the other less facetious thing I say is that when we go out to do management interviews and things of that kind, all we're looking for is disconfirming evidence. Because essentially, when we get out of the car or the train or the bus or whatever to walk up to the company, we're saying, unless I come up with something that tells me that the numbers that I've been reading are way out to lunch, unless I come up with disconfirming evidence, I'm going to go ahead on this one. And so management, if we met them before and they're bad, probably that's a reason not to do it. But they don't have to be, I mean, most businesses are fairly straightforward. They don't have to be intellectual giants. Vertex, for what it's worth, has a new president. And so, I met him for the first time today. He's been on the job for 2 months. so I asked him the vision thing, like George Bush. But I don't, he had a credible, coherent story. But we won't know for 2 years whether or not he's got, the skill set. And we have lots of company managements come into our offices to have meetings and do presentations. And I say to our people, well, really all we're doing is measuring management skill with a PowerPoint. Because they come in and they tell their story and they have their slides just like I do. And I mean, whether or not that is correlated with management skill set is doubtful. So
you don't evaluate their track record. I mean, if you've done a Dupont breakdown and you see that certain elements need to be improved, you don't go back and look at management and see what their track record is in terms of achieving those types of goals.
Not often, as I say. If there have been real outliers, we might do, but the world changes so much for people. And one stock we own, it used to be called Magnifoam. It's now called MTI Global, and they make, as the name implies, silicon foam that's used for insulation. It's used for seat cushions and stuff like that. And I get by one measure, you'd say, we're not happy with it. The stock price has not performed well. The company hasn't performed well. You say, well, management has no credibility because he kept making promises that weren't delivered. But then they're selling, and they got contracts for the Airbus A380 and the Boeing Dreamliner, both of which have been pushed out, by a full year or more. So I don't know whether we should blame him. Maybe he should. Tough to know. Or should he have diversified into other industry groups? But if you have an order from the Airbus 380 and the Dreamliner, you'd say, that's pretty good stuff. Why would we, criticize him for that? He doesn't control the timing on that. So that's why we're reluctant to place too much emphasis on management, because the circumstances usually outweigh the reality.
Okay, thanks.
Okay, yeah.
When you manage a portfolio of securities and you apply your value investing method, do you ever look at correlation between securities to reduce risk?
No. Again, that's so situation specific, I guess. Same with beta. Beta is historically accurate, but not all that meaningful to us. We have really quite low correlations, I think, between our securities intuitively, because we do bottom-up value investing, and so we don't do any top-down macro view. So we, particularly in the small cap area, I say that we have relatively low portfolio risk because the outcomes from most of the companies are company specific. So it really doesn't matter what the Fed does. If you're a liquidation world, you've got bigger problems than whether the Fed or Bank of Canada, cuts the central bank rate by 25 or 30 basis points. I mean, that's not relevant. And so if you built the portfolio that way, I'd say intuitively the correlations are low, because every one of them has dominant company-specific events that are going to swamp any sort of macroeconomic, common factors.
Thank you.
Okay.
We talk about value trap. How do you view a company that has net if it's just cash and account receivable or marketable security minus debt is already net, like it's already positive just from the cash alone?
Cash alone.
Would that be the value trap as well?
Statistically, it's very interesting. More recently, I guess we've been experiencing the fact that having lots of cash sometimes is a bad thing, because those guys go out and buy crazy things with it. So it's a bit of irony. I remember years ago, Prem being excited about a company called G&B Automated Equipment, and he liked it because it had lots of cash. And he kept telling them not to spend the cash. And I said, Prem, the whole purpose of the cash is to spend it. But they, the other danger we've discovered recently is that companies with lots of cash, sometimes the president or some other senior executive thinks they'd like to be a portfolio manager. So they start doing little investing on the side. So Jeff Genovese, I forget the company, but we own one which was exactly like that. And the guy started getting into merchant banking. And he was actually, his background was marketing and advertising. And that was a scary combo. And so sometimes you say, maybe we shouldn't pay any extra for it, because why would you pay more than 100 cents on the dollar for cash in the bank? And so we concluded that it's a double-edged sword.
How do you decide when to sell your security?
Yeah, that's a good question, because people are always good on explaining how they buy, but they're a bit fuzzy on selling. In the small cap area, we don't have a problem there, because if they become big cap in the Canadian context, we're a specialty manager, so we sell them out. That just goes. If they start to look just illogical on that quadrant analysis, if they move into quadrant 3, with a 15-year payback, we say, well, you know, we like the company, it's still a great company, but all of that's impounded in the price. We like to say we'll also sell them if we see a deterioration, a fundamental deterioration in the financial characteristics of the company. To be truthful, though, the way you discover that is when the damn stock goes down 50% one day, and you realize that, you know, the auditor's brother-in-law is getting out, and everyone else knows but you that they got problems with, you know, next day they come out and they violated their banking covenants or whatever, and then, as I say, the stock's down 50%. So the best leading indicator of serious fundamental deterioration is a collapse in the stock price, at which point you don't want to sell it anymore. So those are the three reasons, I guess, after the fact, when it gets big cap or when the valuation is more than full, based on the sort of IGR thinking.
How much work do you put into evaluating the quality of the assets? So like really like doing a lot of due diligence on like the real value of the property, plant, and equipment. I know guys like Whitman and stuff place a huge emphasis on that.
Yeah. If you had a smaller portfolio, I think we could do more than that. But we have 70 or 80 stocks in the portfolio, so we don't really do much more than sort of eyeball the, you know, the physical assets. Well, I visited one company, and well, after a while you begin to pick up little nuances, I guess. Again, you're looking for disconfirming evidence. I visited the company in the UK once, I remember, where I thought they had surplus real estate assets. And when I got out of the car in the parking lot, it was an old economy engineering company near Doncaster, which is where the Industrial Revolution pretty much got started. When I got out of the car in the parking lot, it was all kind of squishy, you know, from oil and stuff that had been presumably filtering in there literally for 100 years, and I thought at that point, well, maybe they don't have, you know, surplus real estate assets. What they have is an environmental liability, and they did. And you know, and one other actually in Montreal, similar situation, where they had a nice 50-acre location just across from Du Collège metro station, and they, you know, I used to think, well, if they can't make money, they were making pipes and tubes for the forest products industry. That if they can't make money doing that, they could sell the real estate. It's a nice location for a shopping center. And I asked one of the directors about that, my hypothesis, one day, and he laughed and said, you know, we've been trying to get rid of this property for years. You know, we tried to give it to the city of Ville-Saint-Laurent for $1, and they wouldn't take it, because we've been doing pickling steel and stuff like that for 90 years in this location. And they, you know, you got a real estate liability. So that we can do. I know you see there's a certain mutual fund commercial you see where it says, you know, this picture of a bolt, and it says, other people see a 50-cent bolt, we see a $50 million liability. No, bullshit. Well, it's a portfolio manager, particularly if you go in a group. You go around and you're taken around, you know, as a group, and you should ask when you meet a portfolio manager to see his or her hands, because they're all soft and white, you know. And so to think you can walk to a manufacturing plant and say, oh, you know, they got it all lined up incorrectly. This should be stainless steel. You know, they should have the you know, the new parts over here, whatever. That's completely out of your. Yeah, exactly. There's Russia over there. I don't think so. I think it's a great commercial. I mean, it really is very, very effective. But the odds of a portfolio manager spotting that kind of thing, you know, are infinitesimal. I think. Yeah.
One last question.
Yeah.
Why do you own 70 to 80 stocks as opposed to, say, your 5 to 10 best ideas?
Ooh, okay. Well, I've been there. The theory would be if you were one of multiple manager, then your 5 best ideas, you know, you get high alpha from that, the 5 best. We did that once with a client when I was at Bolton Tremblay, and we actually had our 20 best ideas. And in the first year, we gave him high alpha. Unfortunately, it's high negative alpha, and we got fired. So I thought, well, forget this. This is this is bad business from our viewpoint. And also because most of the academic studies that you'll have read and the ones you've seen and the ones that you know, George will have on your reading list, I hope, talk about big universes. I mean, they have the whole universe of all stocks listed on the New York Exchange, ranked by decile maybe. So one decile probably contains at least 80 stocks or more. So I want to be sure to capture the small cap or the value effect, not, you know, screw it up and get it wrong. So that's really the reason why I want first to capture the small cap value effect, and second, we'll have a bit of a tilt in favor of value or what have you, but I've been there, done that, and it's not good for business. Yeah. One thing before, I think I see George doing the wrap up here. we did bring from all the way from sunny downtown Waterloo supply of annual reports, because the CFO at Vertec, when he heard that I was going to be speaking to 100 smart, alert, affluent, or potentially affluent members of the investing public, he said, can I give you a bunch of annual reports? So on your way out, before you head to Liquidation World, be sure to pick up a copy of the Vertec Vision Annual Report. This is pretty stale data, but you can read it through, see the business they're in. The CEO, by the way, has changed, so that's one other thing to be aware of. And then I think that's it.
Two quick questions, I guess.
Sure.
You always save them for me at the end. What is the biggest mistake a novice investor can make?
Oh, novice investor. Thinking you know something. And so I suppose in a way I'm saying you should be a passive investor once you've done the basic analysis, and not keep digging and digging and digging and thinking that there is one nugget of information there that will, provide you with the insight. There's a point at which you say, okay, I've done enough homework, I've identified value, I'm going to go with it. And I guess I'd say knowing when to stop is the answer to that question.
And the final question is, what is the biggest lesson in life and investing you learned over the last 25 years?
Oh, boy.
I know everybody has difficulty with this question.
Yeah, okay. Well, certainly from a career trajectory, which I think is probably most pertinent to most people here, I'll give you one insight, because it was the insight I gave the Toronto Society of Financial Analysts. A magazine asked me the same thing. And there's a huge amount of turnover in the investment business, and people are always looking for their, switching jobs and looking for the next fast track or whatever. The good news is there's so much turnover. If you just stick to your job and keep doing it, your boss will either get fired or promoted or move on. And you just move up. So seriously, stick with the program. The other businesses, they're going to be around forever, and you'll never get promotion, and you need to move. In the investment business, there's so much turnover, so much turmoil. Just stick to it. I know it sounds like a value investor, right? Dull and boring, but that's it. That's the key.